MSCI, in case you don't know this company, you have found the perfect video. You have a company that is a software company, very asset-light company. They have 4 key segments. One is they create an index, the MSCI World, the MSCI China, the MSCI Europe. You can create custom index, whatever you want. So that's a great benchmark for funds. Funds, investment funds, compare themselves to this benchmark. Okay, so they compare. Imagine if you are an investment fund in Europe, but you have a global exposure. You buy a little bit of China, a little bit of Europe, or of Asia, the Philippines, and the US, Canada. Would you really compare yourself to the S&P 500 if you have a global exposure? I don't think so. That's not the same game. So let's compare yourself to the MSCI World. If you want to compare yourself to the MSCI World, you need this benchmark. And you will have to pay MSCI to use this benchmark. So MSCI comes to you and say, okay, you want to benchmark your fund against us? Okay, let's pay, $10,000 so you can use your benchmark. And we will give you the value of the benchmark every day. So you have an update, so you can compare yourself to your benchmark every day of the week, every day of the year. It's a cost. It will not be free to compare yourself. And you are a fund. You use a benchmark. And after 2 years, the price of using this benchmark goes up by 20%, for example. It will be quite stressful to change your benchmark. You have built your trust, you have a fully fledged fund, you have your benchmark, you compare yourself to the MSCI World, and you can say to your clients, we are outperforming our index for the past 2 years. If you change your benchmark because the price is getting too high, you want to change your benchmark for some reason. If you change your benchmark, you destroy your track record. Your track record means nothing. So fund managers are kind of forced to pay MSCI every year to be able to compare yourself to the benchmark, to see, okay, we have a long track record of 10 years of outperforming the index. Look at the chart, it's beautiful. So they will pay up. And MSCI knows this. So MSCI is increasing their prices almost every year. I would say roughly 30% of the revenue increases from MSCI are going through price increases. Like 30% of the revenue driver is through only price increases. Not more customers, not more volume. No, just price increases. It shows pricing power for MSCI. First sign of a moat. You have sticky customers, switching costs. It's a cost to change your provider of a benchmark. And MSCI has been doing so for decades now. It was part of Morgan Stanley. Here we go. MAS stands for Morgan Stanley. And they have done a spin-off in 2007. You have the CEO, Fernandez, that was here since 1998 or something like this. The CEO and founder owns 3% of the company. So some decent insider ownership, owner-operator. So I've talked to you about the benchmark. So sticky, etc. This index segment has 75% EBITDA margins. Very profitable. That's the crown jewel. That's the golden goose. Very, very sticky, very recurring, very asset light. No additional cost. There is no incremental cost of having a new client. Literally, MSCI is just giving the benchmark, giving the index. And if you want a custom index, let's say you don't want a benchmark you don't want the MSCI World because you say, no, we invest in ESG, so we are an ESG fund, we want an ESG benchmark. MSCI says, okay, sure, let's create a custom ESG index for you. What do you want? You want some exclusion? Okay, let's exclude weapons. Let's exclude tobacco. Let's exclude all the companies. Let's exclude all the fast food chains, maybe, if you don't consider it ESG. So be it. It will be a cost. To create your custom index for you will be a cost. So instead of paying X amount, you will pay a little bit more because MSCI has created a new index for you. By the way, that's a great way to outperform a custom index. If you are a fund and you don't provide a lot of alpha, just create a custom index with bad companies that you will very easily outperform. It's a great way to fool clients into thinking you can be a great investor. You just benchmark yourself against a shitty benchmark, and life is good. You are a decent investor, outperforming your index. Okay, so that's the first one. That's the index segment. Index segment is 55% of the revenue. So half of the revenue from MSCI comes from index. By the way, I've seen 0 videos talking about this, about MSCI, this kind of analysis, like the way I did to you. So please leave a like to this video. It's a long video, and please leave a like for the YouTube algorithm. So that would be interesting. The second part of MSCI, so we said 50% index, 25% of the revenue, that's analytics. If you need additional data about the companies you have in your portfolio, if you need specific data, risk-adjusted data that you need on a daily basis. I have worked in investment funds and I've seen the risk department asking this kind of data every day. You want to tell your clients on a daily basis what is happening. Some clients will call, you need adjustments, you need regulation, so you need these risk metrics. So you need analytics. MSCI is giving you the analytics and you have to pay for this. So the margins are not that high. You don't have 75% margins. You have a little bit less. You have like 50% margins, maybe a little bit less. Let me check. I'm using this website, Fiscal AI, to know all the segments and all the margins. By the way, if you want to use this website, you have a discount code in my description. You have a link. Click on this one. You have 2 weeks for free. You don't even have to put your credit card. So you can just test it out for 2 weeks. And I have the pro version. I think it's great. You have all the KPIs. Use it whatever you want, guys. But use my link. So you will have a discount. And I will get some money out of the referral. So it's a win-win for everybody. Look at the segment and KPIs. Comment size. The index revenue, look at this line. It was 50% of the revenue, 50, 60, and now 50%. So index, half of the revenue. Analytics was 45% of the revenue. And then the share of the pie has decreased. And now it's only 25% of the revenue that comes from analytics. Okay, what are the margins for this analytics part? Again, let me do a quick reminder. Index EBITDA margins, so the first segment about index, 75% EBITDA margin. Okay, very profitable, crown jewel. The second one is, where is it? Analytics EBITDA margin, 50% EBITDA margin. Can you name 10 businesses with this kind of margins? It will be very hard. So very profitable, and the profitability has increased. More data, more pricing power. The third segment is ESG. So ESG is very new. Since 2019, it was 5% of the revenue. Now it has become 11% of the revenue. So nothing big it's not part of the story. It will not change the investment thesis for MSCI, not at all. It's very recent and it grew a lot during COVID. This is the reason why the stock went up a lot during COVID. Look at this. COVID, and then boom, you have a lot of revenue growth that came from ESG, and Wall Street and everybody extrapolated this kind of growth into the future. So the expectations were really high for MSCI and the ESG segment. And then we learned that the ESG trend was a fad that was only hype and unprofitable, and it was becoming victim of its success because political parties started to talk about ESG, and then it became a weapon of political stuff. So companies, including MSCI, said, oh, let's rename the ESG into sustainability because, we don't want to be associated with the ESG world. We just want sustainability, climate, but let's reduce the investment into ESG. It's not that profitable. Let's focus on index, very profitable. Analytics, very profitable. This is a great sign of flexibility from management. If you look at recent interviews, this is what they say. And if you don't know what I'm talking about, please do some research about MSCI. You have great free content on the internet. You can have all this data. And again, I can help you with that. You can book a call, actually. Okay, so let's see the custom metrics. I created this custom metric, the ESG EBITDA margin. Here we go, 30% EBITDA margin. Yes, pretty decent. Pretty good, but I would prefer the other margins. And then the last part, where they make money is private equity. It's called all other operating revenue. It's 9% of the revenue. It's really not what will move the ship actually. And the margins for the private equity part are 25%. So what I love about MSCI is the biggest segment, index, is the most profitable one by far. And this is what the company is focused on. They recently hired a veteran of MSCI, somebody that worked for MSCI in the past, to improve the index segment. I think it was in 2023, or I have a doubt. And they rebranded the index segment, more custom metrics, more custom data, because you had some complaints about MSCI. That would be pretty interesting to you. You had some complaints for MSCI because of, price gouging. You increase the prices too much, but the value of the benchmark is the same. So customers were not really happy to pay higher prices. They were complaining, but still paying because you have high switching costs like Microsoft. So to some extent, the business model of MSCI is very recurring and sticky like Microsoft. And then in 2022, 2023, they said, okay, customers are not really happy with the price increases. They don't think it's worth it. So let's increase the value they get. So this is exactly what they said. They created MSCI One, so a huge software that centralized everything, very clean, very efficient for funds or any asset managers. And they implemented the software, climate, new data, so you get more with your money. So clients are more happy right now. You get more value with the same amount of money. So you can justify the price increases by a lot more. And seems like it's working. We will see in future years if they continue to increase the prices, but seems like it's working. So I've talked to you about the moat, the quality of the business, the different segments. What about the growth rates? What about the margins? If you look at the margins, the gross margins are 80%. Beautiful. Operating margins, 50%. See how profitable it is? It is just beautiful. Net margins, 40%. Free cash flow margin, 47%. It's huge. And look at this. No cyclicality whatsoever. The revenue is up and to the right. Look at this in blue. The net income is up and to the right. And we are living in a world with inflation. Companies that will thrive in this kind of environment will be companies with pricing power that can increase their prices to offset the costs. So, one, MSCI has 80% margins, gross margins, so they can have immense pricing power. They can increase the prices, so they can offset inflation. And two, they don't have a lot of costs. They don't have a lot of capex. The capex is very minimal. I have created this custom metric, 8%. So the capex is 8% of the operating cash flow. Very minimal. They don't need capex to grow. They have the infrastructure and they don't need reinvestment. They don't need costs. And look at this. The net income is up and to the right. The free cash flow is up and to the right. Look at this. Zero cyclicality. You are paying for capitalism and funds. And they are doing buybacks with the cash. What do you do with the cash? You do buybacks and you do dividends. A dividend yield of 1%. Let me tell you something else. Let me show you the free cash flow here. I've seen nobody on Twitter or YouTube talking about this. Let me show you the free cash flow. Where is it? I'm looking at MSCI. Come on, show me the free cash flow. Don't I have the free cash flow? Isn't it working? That's strange. Cash flow statement. Yeah, it should be a bug. Free cash flow is here. Okay, now that's the chart for free cash flow. Up and to the right. And let me show you the buybacks. So the amount of capital that is being given as share repurchases. And the dividends. Most common dividend paid. This one would be good. Okay, now that's a complete mess. I agree with you. And let me stack all these bars and let me tell you something. What you can see is the allocation of free cash flow towards buybacks and dividends. At the top of this document, you have the free cash flow up and to the right. At the bottom of this line of this document, in blue, you have the buybacks, the amount that they repurchase shares. And in orange, you have the dividends. What you can see is the sum of the dividend and buyback are almost equal to the free cash flow. That means all the free cash flow they generate is being paid to dividends and buybacks. They don't need capex. They don't have a lot of costs. They don't need a lot of capex to have new warehouses, new facilities, to implement AI like Microsoft or Google or etc. They don't need this. They don't need to reinvest in their growth. They have the infrastructure. It's like a toll booth, and they just take the money everywhere. I would say to some extent 95% of the revenue is recurring. You have a very high retention rate, and they take money every year. And as the world grows, you get more money, and you can use all this cash to repurchase your shares in a flexible way, meaning, as we said for other companies like ASML, management is telling you when the stock is cheap. They are doing more buybacks when the stock is cheap, decreasing its value, like the PE ratio is dropping. So management is flexible. Management is good when it comes to capital allocation. When the stock is expensive, they don't do any buybacks. Look at this. I told you in 2021, the stock went to the sky and the stock went up immensely. You have a PE ratio of 70, something like this. So very expensive. They just stopped the buyback. A little bit to offset the SBC, but a tiny bit of buyback. And then the stock dropped in 2022 and they pounced heavily on the buyback program. And what do you see now? You see more buybacks, more than $1 billion being paid to buybacks in the last 12 months. And the CEO is buying. The CEO of MSCI has bought shares for himself at several instances, including 2 days after this drop in 2024, like here, and one in another buying range in February 2025. What was the price of MSCI in February 2025? It was at 574. Now, today, as I'm recording this video, it's 180, roughly the same. You know what? I bought MSCI at 2 instances, around here and around here. I have an average price of 550 or something like this. And for all these beautiful qualities, recurring business model that this business has, what is the valuation? So you can take a look at the forward valuation for the price to free cash flow. And here it is. As I told you, the valuation in 2021 was very expensive, like a very high PE ratio. The forward price to free cash flow was 50 at the time. Even if this is a very high quality business, this is very expensive. And then it dropped. And I bought at a price to free cash flow forward of 27, doubled down here at 28. So that's maybe the cheapest valuation the stock had in 5 years. And for all the good arguments I told you previously, I think it's a pretty good buy. And that's the latest thing I have bought personally on my portfolio in recent weeks. So I love your pick about MSCI. I hope you liked this kind of analysis about MSCI. I think you have a lot of moat that reminds me of Fair Isaac, FICO. So branding, switching costs, economies of scales. You have pricing power, immense margins, very recurring, retention rate of 90%. I can even show you what I mean. You look at this investor presentation. I can give you, is it this one? 75 slides. I want to show you the recurring business model. Revenue, adjusted EBITDA. No. Let me scroll down. This is the run rate, index revolution, passive investing. Yes, as you have more flows into passive investing, MSCI will make more money. Let me scroll. Subscription run rate, retention rate. Okay, retention rate is 90%. You don't have churn. Customers stay. You can say whatever you want. Customers stay. And run rate growth, analytics. And you have growth rate. Only 25% of the revenue of this business is linked to the market. If the markets drop like they have dropped in 2022. Because only 25% of this business, of the revenue, is coming from AUM. Look at this, I can show you what I mean. This is why Fiscal AI is so great. Please use the referral link, it's a great website. You have this asset-based fees. So the amount of revenue that is generated when markets go up, when the AUM goes up. Look at this. And as a percentage of the total revenue, in the past, it was 16% and then 20% and then 20, let's say 25%. So when markets drop, like in 2022, only 25% of the revenue will be impacted. That means the remaining 75% of the revenue will be recurring, resilient, even if you have a crash in 2026, stock market crash. They just don't care. People will pay like they pay the Microsoft back office. And I can show you what I mean. If you look at the investor presentations, you can see the decline in 2022. Let me check. Is it this one? Recurring? No, maybe yes. Asset-based. Here we go. This is a line. In blue, you have the revenue from the index that came from asset-based. So when markets go up, like in 2020, 2021, more revenue because of more AUM. Markets go up. And then in 2022, we entered a recession, we entered a bear market, markets went down, and this revenue that was linked to the markets went down. This is the growth rate negative. And then markets rebounded and it went up again, okay? So this is only 25% of the revenue that will be impacted. This is this blue line. For the rest, the subscription run rate, stable, 11% growth. The markets drop, okay, they don't care. 12% growth, 13% growth. They don't care at all. What I mean is 75% of the revenue, 75% of all the revenue are quite stable, resilient, with 80% gross margins. What do you think would be the valuation of this kind of business? I think it's a better business than average. So it deserves a better valuation than average. The PE ratio for the S&P 500, as I'm recording this video, let me show you the proof of what I say, is like 29. Let's say it's 29 or 30. Do you think it deserves a PE ratio higher than this? My guess is yes. So maybe the PE ratio that is a little bit higher than average is warranted. Now for MSCI, the PE ratio, when I bought it was like 32, 35. Now the stock has rebounded since I bought. Lucky timing. I bought here and the stock went up 10% immediately. So PE ratio of 40 right now, forward PE ratio of 34, price to free cash flow of 33. And I showed you the forward price to free cash flow ratio before on FinChat. So a little bit expensive, a little bit of a premium, but I think it's warranted because of the quality of the business model. So I bought when the PE ratio was a little bit lower, like PE ratio of 30, 35. And I will hold. I think the analysts are underappreciating the quality of the assets. If you look at what is priced in for MSCI, I think it will grow by more than 8% per year. This is my take. Maybe I'm wrong. Maybe I'm right. Nobody knows. But if you look at the earnings per share for MSCI, what Wall Street is expecting here, this on Fiscal AI, you click on estimates, EPS, and you put this toggle on percentage change. On Wall Street is expecting the earnings per share to grow 13% in 2025, 12% in 2026, and 13% in 2027. My guess is it will grow by more than this. It will grow by more than this because of all the levers they can have. They can do a lot of things to increase the earnings. And they have done this in the past. If you look at the past 10 years, let me check, 10 years, this. The earnings per share, the diluted EPS of this business have grown 24% per year. And Wall Street is expecting this to be cut in half now. They expect the earnings per share to only grow 12% per year. In a world where you will have more inflation, more ability to increase your prices. Yeah, I doubt it. And I think to some extent that Wall Street is wrong on this one. I think they can grow by more than this. So to some extent, it's cheap, undervalued. So I like your pick.